Hello, everyone. I'm going to give us a little second to get a couple of people in. But I would like to welcome everyone and thank you for tuning in because I have a special guest with me today. His name is Andrew Buck, and we will be talking about mortgages. So let me get started. Hi, everybody. And before we get started, actually, let me just let you know this is live. This is a live question and answer specifically for mortgages. And if you put your comments in the comment section, I will be able to read them and they will go on the bottom of the screen as you see the down payment costs here. They will be able to go on the bottom of the screen, and Andrew and I will be able to read them live. And we have our first. Hello, how are you today? So let's dive right in and introduce our expert for the night. Andrew has been a senior mortgage loan consultant at Loan Depot since 2016 and was selected and recognized by Our Detroit Magazine as one of Detroit's real estate all-stars in 2020 and 2021. He is very active in his community where he served as leadership director on the board of directors for the Greater Farmington Area Chamber of Commerce in 2020. More recently, he was elected to serve on his own HOA to sustain and improve the beauty of his neighborhood and work towards finding ways to increase property values. He's chaired several Farmington Holiday Lights and Farmington Kindness rallies. So we are listening and asking questions to someone who is very deeply rooted in their community and rooted in educating people in the home buying process. So I would like to welcome Andrew. How are you today?
Hi, Anika. I'm good. How are you doing?
I'm doing very good. How'd you like that intro?
That made me feel really good, honestly, hearing you say all those things. So thank you very much for that.
Oh, you're so welcome. You're so welcome. So we do have our viewers on with us now. So let's go ahead and dive on in. With us being in the real estate industry, we have a lot of our clients come to us and say, "Hey, I'm ready to buy a house. This is it. Show me houses. Give me money." So I like to tell people you have to have a pre-approval first. So there's a lot of misconceptions about having a pre-qualification and a pre-approval. So can you tell us a little bit about the differences between those two?
Sure. Really, it's very similar. Pre-qualification, I don't really do those. So that's a very basic analysis of what it looks like you might be able to do. And you might be able to get a letter from a lender that says, you're pre-qualified to borrow this amount. It looks like it might work out. Pre-approval is really what you want. That is a more in-depth look at your credit report, your income, your assets, and once you've collected the information that you need, like your pay stubs or your W-2s or your bank statements, and the credit report has been analyzed and reviewed to make sure that everything on there is accurate, we have a conversation about all of that information. Somebody like me, a loan consultant, is going to make sure everything is correct and click the button, right? Click the button means we're going to run the automated underwriting system. And that's going to a computer system that's going to look at the credit report and look at all the information that's entered on the application, and it spits out a response. And it might be approve, eligible. That's the response we want, right? And
right.
Then we're good to issue an actual pre-approval letter. And that letter is going to say, hey, John, you've been qualified to borrow up to $250,000 towards the purchase of a primary residence. We've looked at your credit, we've verified your income, we've verified your assets, and the underwriting system says you're good to go. And all these things mean that, there's a really good chance that you're going to be able to get this loan. The things that we don't know yet, right? We've got to get an appraisal on the house. We've got to get clear title on the house to make sure that the seller can legally sell the property to you. And we've got to get a final underwriting approval. And that means that, we've collected your income and your assets. We've got to send that into our underwriting team once we have an offer to purchase the house accepted by the seller. and we have the appraisal, and we have title, we need to let our underwriter look over all those things and stamp it final approved. And that means that at that point in time, we can lend out that money to you and you can close on the house and actually get the keys. So, that's why the pre-approval is so important, because it is, in fact, the indication that you have the ability to borrow that money. And if you were only trying to shop for a house with a pre-qualification, the seasoned experts in the real estate market, like Anika, would know that you haven't really done that much homework. You haven't really looked into it as far as you could have looked into it. And so if Anika is selling a house and one of the buyers was coming in with an offer that had a pre-qualification letter with it versus a buyer that has a pre-approval letter with it, she would be more inclined to accept the offer from the pre-approval, because she would know that the lender has done their homework and made sure that that buyer can actually qualify for that financing.
And I couldn't have said it better myself. Thank you, Andrew, because like I said, that's a big, it's a difference. It really is, and it does matter. So thank you for that information. Now, I want to take it back a little bit when you were talking about the different factors of being pre-approved. You mentioned credit, and I want to ask you, what is a good credit score for buyers to have?
Yeah, that's a very good question. Obviously, a very common question. It depends. Really, for the most part, and there's a lot of information for later that we're going to go over that will tie into this. But ideally, you would want to be, if you're looking for some down payment assistance to help you cover the down payment that you'll need to bring and some of the closing costs that you'll need to pay. Really, we want to see the credit score at 640. And mind you, there are 3 credit scores that everybody has. And so that the credit score that we're talking about, the qualifying credit score, is going to be the one in the middle. Not the low one, not the high one, but the one in the middle. So if you have a 600 and a 640 and a 700, your credit score is going to be 640. That's the one that we're going to use as the lender to qualify you. Now, we have plenty of programs that don't require the 640 that will work as well. So we can go as low as 520.
Okay.
Which is very low. Most people have a credit score at 520 or better. The catch is, between 520 and 580, you will need to have at least 10% of the purchase price to put down, which for many of us is
I'm sorry, can you say that one more time? What would you need?
10%.
Out of 520? 10%. Okay.
Between 520 and 580, we can do FHA mortgages where the buyer or the borrower is putting down 10%. So you can borrow 90% of the value of the house.
Okay.
You're going to buy a $200,000 house. You can borrow $180,000 to do that. You'll have to come up with the other $20,000. So if your credit score is in that range, you will need more funds to close on that house than you would if your credit score was higher. Now, once we hit 580, we can do 3% or 3.5%. So that drastically cuts down the amount that you would need to bring if your credit score is above 580. From there, the down payment requirements are going to be the same all the way up to 800. You can go as low as 3% down.
Okay.
You can borrow 97% of the home value.
Interesting. That's definitely news to me with the 520 and having 10% down. That's wow. I like that, actually.
Let me throw this in there too, just to be clear. Credit is just a snapshot in time.
Mm-hmm.
And that's one thing that I feel a lot of lenders forget, or they don't account for that sometimes. So they may look at you and stamp you with your credit score and give you the runaround or tell you don't qualify, and don't listen to them, right? There are things you can do to get your credit score to jump 40, 60, 100 points.
Mm-hmm.
And you can accomplish that with the help of somebody like me. We can do that within a week to 2 weeks if the situations are right. Now, mind you, there are some things out there, big things like foreclosures on real estate in the past or bankruptcies. You may have lost a card or a repossession, or even voluntarily turned it in, or you let one of your credit card payments go and it turned into a charge off. I'm no stranger to seeing these things on credit reports, and I'm not afraid of them. There are some things you can do, and there are some things that are outside of your control. And you might have to wait for those things to become less severe or have less of an impact on what your credit score is today. One of the major things is your credit card balances, right? So if you had a card that was maxed out or close to the limit, you would be able to pay that credit card down. We can get a printout or a letter from that credit card company which says what the new balance is, and we can send that into our credit reporting company, and they'll update the balance for us quickly, 3 to 5 days. And they'll issue a new report with a new score. We even have a credit simulator tool as a part of that process. So we can literally go in there on your credit report and say, we need a 640. We need a 640, right? And it will tell us to the dollar what you have to do. So it might say, pay your Capital One card down to $211. Get a printout of the balance, or get a letter from the creditor and submit that here in this tool right here. Once that's done, it starts the rapid rescore process, and within 3 to 5 days, we could have a credit score of 640. We could be at 600. We can make it happen that quickly, and that's what some people don't realize is that until we really look at things, and run the simulator tool and see what we could do, you could turn that 580 into a 640 and be able to get the down payment assistance that you need. We can do that type of thing. So don't let the credit discourage you, even if it's not 3 to 5 days or 2 weeks. It might be a month, it might be 6 months, but really taking a look at it right now with somebody who's going to spend the time with you and explain things to you and get you on the right track. That's where you're going to be able to get to the point where you're able to qualify for a mortgage and able to buy a house at some point in the near future.
Exactly. And that's what it is that it is an attainable goal with the right people. So let me ask you, what type of documents do people need other than their credit score, of course? What do they need to be able to qualify for a
loan? Documentation is pretty simple. It does depend on what you've got going on. So if you're just an employee and you work an hourly job or a salary or something like that, typically we get the most recent 30 days of pay stubs, at least the most recent pay stub, just whatever that is, and your W-2 from the most recent year or 2 years, depending on the loan type. So typically we say, typically lenders will say 30 days of pay stubs, 2 years of W-2s, the most recent 2 months of bank statements, and it depends. There might be some other things. So let's say, for example, that let's say you're self-employed. Then we don't need pay stubs typically, right? You may not be giving yourself pay stubs. You don't have W-2s. You might have 1099s, depending on the type of self-employment. If you're like an independent contractor, you'd have a 1099, and that would show us what your gross monthly or gross annual income is for last year. But with self-employment, it's really important to take a look at the tax returns, because your tax returns essentially is your profit and loss statement where you're going to write off some of your expenses, and that needs to be taken into consideration as far as what your income actually is. Now, there are some things when you're self-employed that we can add back to your income, like, for instance, depreciation, like the business mileage that you drove for the year. If you had any depletion on your tax returns, or the business use of your home. Those are all things that are not actually dollar expenses that your business spent money on. They're things that the IRS gives you credit for because you're essentially losing value through depreciation or depletion on those items. And they do serve as a tax credit to offset your income, but they're not actually money that you spent out. So those things can be added back to your income, to your qualifying income. But for self-employed people, the point is really, we want to look at the tax returns up front and properly calculate that information to make sure that we're not sending you off, looking at homes without having properly figured out what your qualifying income is going to be.
Mm-hmm.
Other income, like retirement income, for example, maybe you get Social Security or disability. There are like award letters for that type of income. And there's many other types of income. So it really just depends. But we definitely want to get income documents to prove what income you earn and assets to show what money you have available towards the purchase. It's not always based on the money that you have right now. A lot of times we're saying we might be able to save up, a few $1,000s towards this over the next 30
Mm-hmm.
days. I'm able to get gift funds from my relative, or I've got this tax refund coming. I know it's going to be here. We want to use that to buy the house. You can still be pre-approved even if you don't have the money in the bank at the moment.
Alrighty, and there you have it from Andrew. And for all of our viewers who are just coming on, or who have recently joined us, we are doing a question and answer session with Andrew Buck. He is a senior loan consultant with Loan Depot. If you have any questions for him, you can put them in the comment section. And we do have a question. Our question is there a minimum income level for those that are self-employed?
No, right? So there's no minimum that you need to make. It's not like, if you make $20,000 in the year that you don't, you can't get a loan at all. What it does mean though is that everything in lending, mortgage lending, is based on what's called the debt to income ratio.
Yes.
All right. That is just a measurement tool, and it measures how much the bills are in relation to how much you make. Okay. So the bills are a combination of the monthly payments that show up on your credit report, and whatever the proposed housing payment is, whatever the new housing payment's going to be, and that includes in your loan payment for principal and interest on the loan, also the property taxes and the homeowners insurance. And there may be some other expenses that are included in particular types of housing, like if it's a condo, you have the condo association dues, for example, and some houses have that too. You may also have some type of mortgage insurance, depending on the type of loan, and that's a monthly amount that you pay when you're borrowing more than 80% of the purchase price. Okay, so let's backtrack again one more time so we don't get lost. But the debt to income ratio is a measurement of the bills in relation to your income. And remember, the bills are the monthly bills on the credit report and the house payment that you're about to buy. So we can make adjustments to the debt to income ratio three ways. You can have more income or less income, right? And that will change the measurement. That will change the debt to income ratio. Or we can eliminate debt. We can eliminate bills on the credit report, right? That changes the measurement of the bills. Or we can, the housing payment, right? That's the one that fluctuates to determine the debt to income ratio the most. So if you make whatever it is that you make, the housing payment will be limited to a certain amount. And that's what limits the loan amount that you can borrow, because the loan amount is part of the monthly payment. That's how the monthly payment is calculated, by saying you're borrowing $200,000 at 3.5% over 30 years. That equates to a monthly payment of $900 per month. So that's part of the debt to income ratio. And if that would be too much for your income, then we either have to look at getting more income, we have to eliminate some debt, or we have to do a smaller housing payment. So if that's part of the pre-approval process, is figuring out, okay, you're self-employed, what is the income that you have, what properly calculated in accordance with the mortgage guidelines, to figure out what you have, and then figure out what you can afford. And that doesn't mean necessarily that you can afford $100,000 house, but it means that based on your debt to income ratio and the limits on the debt to income ratio for this particular loan type that we're doing, you can have a monthly payment of $1,000 per month, for example. So based on $1,000 monthly payment in this price range, you might be looking at 150 or 175. As long as property taxes are this and insurance is this, we know the interest rate, we know the amount borrowed, so everything can be calculated out to figure out roughly what your price range is. And then we just need to take it one step further and look at each house on an individual basis to make sure that if we think we're close to the maximum that you can borrow, to make sure that the property taxes on that house aren't absurdly high, or to make sure that we're not going to get surprised by your insurance premium being a lot higher than what we think it might be. So
and you're right. Because as a realtor, we always have to come back and ask you all what these property taxes should be. What's the maximum for the property taxes and things like that. So I definitely understand what you're saying there. We do have a couple of questions in our chat.
Okay.
Our chat in the comment section. So we have now, the first one is, can you negotiate a compromise with a creditor for debts owed?
Absolutely. It's something that I'm having conversations about with people more and more often, because as I'm broadcasting that, we have the ability to look at a credit report and see what's going on with it and try to fix some things and get the score up in a relatively short period of time so you can get the pre-approval and get out there shopping. One of the things that we see a lot is credit cards that went into charge off, or even more commonly, collections, right? Like you had Comcast and they say you didn't turn in the equipment, and now you have a $300 collection on a report from LV Energy or something like that. You guys know what I'm talking about. Yeah, you can absolutely negotiate. Here's why: because the creditors, the collection agencies, I should say, for collection agencies, their whole business model is to buy bad debt, right? And they buy it at a discount. So they go to Capital One and say, all right, we want to buy up all your bad debt for 25 cents on the dollar, which means that for John, who owed them $100, that collection agency bought that debt for $25 and is still trying to collect $100 from John. And if they do, they make $75, right? Okay. So that's where it comes into negotiation with them, is because you know that now. And you can call them up and say, I'm willing to offer to pay you, you could say 25% of what I owe. They may not accept that. They may counter you. Maybe they counter you at 50%, but you just got it for half off.
And there's that negotiation.
And they're making a profit. That's money in the bank for them. Otherwise, they weren't getting that money from you. Now, here's the thing that's really important with that. Paying off a collection doesn't help you.
Okay.
Say that again. Paying off a collection doesn't help you. All right. It's collections are bad. They're bad accounts. At that point in time, when it gets to a collection, it's just bad. It doesn't matter whether it's, you owe $300 or you owe nothing. If the collection remains on the credit report, it's still going to be bad. It's still going to show you had a collection. Yes, you paid it. Yes, it says that you owe nothing, but it still shows that you had a collection. And while I'll say that it's great to pay them off, even if they're staying on your credit report. If you owed somebody something, you should, and they're right, and you owed them, if you're really trying to clean things up, you should probably pay stuff off. But when it comes to paying collections, one of the things that I suggest is that you talk to the collection agency and that you ask them to remove it from your credit report, to delete it from your credit report as if it never existed.
Yeah, we had somebody in our comments say make sure they remove it as well. So yeah, you're on it. I can't see who it is, but
and if they'll send you a letter or send you an email to say that they will, that's one of those things that we can take to the credit reporting company, and give that to them, and they will update that and remove that collection quicker. The collection agencies will tell you it takes 30 to 45 days at least for that information to hit the credit bureau. But again, if you do accomplish that, we can get that done a lot quicker through a rapid rescore. Yeah, and you can, if it's not a collection agency and it's just a credit card company, you can always try to make an offer to settle the debt that you owe. It's worth a shot, and it's your credit report may reflect in the notes section on that account that you settled for less than you owed.
Mm-hmm.
I don't. My opinion on that is that it doesn't necessarily have a negative effect on your credit score if you settle a debt. It's better
And that's
than.
really good to know, because people might deter from that because they think it'll have a negative effect on their report. So that's a really good clear up there. Um, I want to kind of go to another question, because it seems as if you guys, we might go a little bit over 30 minutes, but that's okay, because we want to make sure that some of our questions are answered, as long as Andrew, not really as long as, but we don't mind going a little bit over if that's okay.
No, it's fine with me.
Alrighty, so we do have another question in the comments. Is there an advantage to obtaining a loan from a mortgage lender versus a bank or a credit union, or vice versa?
Yep, that's a very good question. My take on it is, and all right, I'll admit that I'm partial because I don't work at a bank. I work for Loan
Right.
Depot. Loan Depot is a mortgage lender. That's all we do, right?
Mm-hmm.
We focus on one thing and one thing only, and that's why we are so good at it. Um, we are geared to providing the most efficient, customer friendly, creating a good reputation for the mortgages that we do. And that's why I think it's in your best interest, if you're really trying to get a mortgage, is to go with a mortgage lender, right? Banks are a great place to borrow money, but just keep in mind that banks are doing checking and savings accounts, they're doing auto loans, they're doing certificates of deposit, they're doing IRAs, that they're doing, who knows, that all of the different aspects and things that the bank has going on. And
Mm-hmm.
I've always, my understanding is always that translates to longer turn times. It takes longer to get responses. It takes longer for underwriting to happen. It takes longer to get your approval, your appraisal, longer to close. And, that can be worth a lot when it comes down to the actual experience that you're going to have. Or, if you're going around carrying a bank pre-approval letter with you, if your offer is getting turned down, you may not know why. You just know it's
Mm-hmm.
not getting accepted. And that could be one of the reasons why. If, depending on the lender that you're using, you want to make sure that that person or that company has a very good reputation. um, let me add that banks really are only open from 9 to 5. The
Right.
typical home buyer is doing home buying stuff after 5.
Right.
So if you're out looking at a house and you need
That's what
you
I'm
need an
saying.
estimate, you need to check those property taxes or make sure that you
Mm-hmm.
qualify for this house. You need a guy like me who's available for you, pretty much 24/7. Like I really do work late to try to support the people that need me when they need me. I don't expect them to be available on my terms, right? I'm here for you. The weekends too is another huge. I mean, that's when most people are out looking at homes. So
Yeah.
um, imagine how it feels to be the listing agent, the realtor who's selling a house, getting a call from the mortgage guy on Sunday morning to tell them about how qualified the person is making the offer on the house. And that just, it goes to show that, the lender actually cares, that they've done their homework, but also that they're going to be there when, if something were to happen to go wrong and we need some answers, at 8 at night, my client needs answers now. That's how it is, right? Whether you're a buyer,
Mm-hmm.
seller, the clients want answers now. The realtors want to give answers now. And a lot of times those answers are coming from title companies or lenders. So really you want to work with somebody who's available. And, most of the time at the bank, the bankers are not available outside of bankers hours.
That is so true, Andrew, because when I tell you, I text my lenders, I say, hey, after 7 sometimes, I mean, we know we just did a deal together in December, so I was texting you too. And you were definitely there and available. So I do have another question in the chat. Are you familiar? Oh, let me show it. Are you familiar with mortgages under a business name?
Yeah. Pretty common to have your business in like an LLC type of organization. Um, you can close in the LLC if you need to for some reason. Like, let's say, for example, you're buying a rental property, whether you intend to rent out to someone, or maybe you're buying something that you want to use for Airbnb, or something similar like that, Verbo or something. Then you can close in the LLC. That's okay.
Okay.
Specifically, you got to do it in Fannie Mae. You can't do it Freddie Mac. But if you're buying a house for you, typically, you would buy it in your personal name. And even if you're buying a rental property and it's the loan is done in your personal name, you can always deed the property to your LLC at a later time.
Yep. And actually, that brings me to my next part, is the loans. So what loans do you offer? I know the main loans are conventional and FHA, and can you tell us a little bit about those and the loans that you work with?
Yeah, absolutely. Conventional and FHA, especially in the metro area, those are the most common. There's also VA loans. Those are only for veterans who are eligible to receive benefits from the VA. There's also USDA rural development loans. Those are not as common as FHA or even VA. Those are for rural areas, so they don't work. They're not, it's ineligible to use them on properties that are located in certain areas, metropolitan areas. And there's a map online. If you're interested in that, I can provide you with some resources to see where the lines are on the map that you can use those. The advantages of USDA and VA are that they offer 100% of the purchase price you can borrow. So you don't have to put down a down payment. There are still closing costs, but theoretically you could negotiate for the seller to cover closing costs, or get lender credits from the lender, or use down payment assistance. And if you were to use one of those 100% programs, you could get away with doing it with $0 out of pocket. There are some other loan types that are out there, typically called non-QM, and those are just alternative financing. So, for example, like a common one is if you're self-employed and your tax returns don't show that you make a lot of money, but your bank statements do, then you can use your bank statements as your income documents and be able to qualify for the loan that way. For example, another one is investor cash flow. So that's where you're buying a rental property, but you really don't have the income needed to qualify on paper. The cash flow of the property just needs to be at a certain amount. So as long as the rental income were to exceed the payment on the house by 10%, let's say. So if you were going to get rent for $1,000 a month and the payment was only $900, you qualify. There's really nothing else to look into on those types of loans. So that works on a rental property. Things like that are out there.
And everybody, in order to know about these loans, you definitely have to call someone like Andrew to see what it is that you need to qualify for whatever loan. You really need to be definitely upfront and honest about what you want to use your loan for, because that is very important, so that you can get the best product that he had. You can get the best loan option that he's able to offer you. Let's see. We have a couple of more. Let's see. They are already paid. Okay, these are comments. Okay. So what happens is that I see you all as Facebook users versus who you really are. And so, okay, yep, they are already paid. Oh, okay. How much should a cost in relationship to your income? How much should a house cost in relationship to your income?
Yeah. It depends. So the easiest way to explain it is probably if credit's okay, then you would want all your bills, right? Which again, the way that I say that is the bills that show up on your monthly, on your credit report, the monthly bills that show up. So the car payment's $250, the credit cards are $100. right? And you got student loans for $50, right? That's $300 a month right there. That's your bills. And then you got your housing payment, which is we don't know what that is yet. We're just saying your proposed housing payment. So let's say that's $700 a month. Now that's your total bills are $1,000 as it stands right now. Now we can make changes to the debt. We can make changes to the proposed housing, but if you made $2,000 a month, theoretically, your total bills should not really exceed 1,000. They shouldn't exceed half. If your credit is bruised and banged up a little bit, and we're like closer to 580, that might be even more limited than that. If we're doing the down payment assistance program, they have some limitations on that they set at 45%, a little less than half. Right? If the credit's okay and we're doing FHA, we can go even higher. We can go to 57%. So it really depends on the loan type, what the maximum debt to income ratio is. Some people have said in the past that it's really healthy for you to not have your house payment be more than like a third of your income.
Okay.
But it really depends on the situation. Like if you have a ton of debt, if you have 3 cars and 10 credit cards and you got a lot of bills that you have to pay monthly, we might be limited on how much housing payment we can do until until we make some progress on some of the debt. There's other things too that are considered in that, right? Like do you pay child support? Do you have alimony? Do you have an IRS installment? You're trying to pay back some taxes that you owe, or other things like that might not show up, but you need to keep it in mind for yourself. Also, what are your other expenditures? Like, really, this is about not just what you qualify for, but really you should be responsible and taking a look at what some of your other expenditures are. So do you like to go out a lot? Do you like to go out to the movies? Do you like to go out to eat? Do you like to shop? Do you have other hobbies that you're interested in that might be taking up a lot of your funds? And, can you really afford to have in your own budget? Can you really afford to have the house payment for the house that you want, or can you compromise? Can you, can you think about things as far as when I have the house, I won't be going out to eat as much because I'll be cooking at home. I won't have to do DoorDash because I'll have the kitchen and I can focus on making food and planning my meals, right?
Like your brand new kitchen.
Brand new kitchen, right? Yeah.
Right.
So those things come into play too. And really the biggest thing though, regardless of whatever the monthly expense is, right? The monthly, I realize that everything we do is focused on like per month, right? The car payment is going to be this much per month. The payment on the house is this much per month, but you have to think longer term than that. Buying a house is the single easiest way to grow your net worth. If you buy a house today for $100,000, in 5 to 10 years, it's going to be worth it on the current level of appreciation. Not even on the current level, even as things calm down, it's going to be worth a lot more than what you buy it for in the future at some point. And that money is yours, right? You buy the house for $100,000 and you borrow $96,000, and over 5 years you make payments and you pay down the balance till you owe $75,000, and now your house is worth $200,000. You sell the house, you now have $125,000. So regardless of whatever the monthly payment is, like if you can swing it, if you can pay it, it's going to pay off in the long run. You're going to earn money by owning a house, especially compared to renting, right? Because at the end of your 5 years of renting, how many dollars do you have?
How many dollars do you have? Yeah.
You have zero. You have $0. When you own a house, even all the monthly payments that you spent, you still have money left over when it comes time to liquidate that house. Or you can turn that house into a rental property and use the income that you get from that towards your new mortgage payment and help make that mortgage payment more affordable.
And that it's so funny. So it's funny how we're talking about it because it rolls into the next questions. But we do have another one, and it says they ask, do you handle mortgages for current homeowners?
Absolutely. Yeah. So if you already have a mortgage, or even if you don't have a mortgage, you might be able to take out a new one that's better. That's called refinancing.
Refinance.
You can use it to take cash out. You can use it to do renovations on your house. You can use it
Mm-hmm.
to buy a new house. You can lower the interest rate or extend the term to make a lower monthly payment, or you can lower the interest rate to try to pay off the loan sooner with a shorter term. That would save you a lot of interest over the life of the loan. So there's a
Mm-hmm.
lot of reasons why you might want to refinance a loan. Um, yes, so yes, we do.
And what is that called? That type of loan. What is that called?
It's a refinance, mortgage refi.
Oh, just okay, refinance. And you mentioned some down payment assistance uh, programs, lender credits, and things like that. Can you go a little bit more into detail about that?
Yes, I can. The big one is the MISHDA program. MISHDA is MSHDA. That's Michigan State Housing Development Authority. And that is a state agency, as it sounds, that basically raises funds to give to home buyers. They set some rules on who is eligible for this, and I can talk
Mm-hmm.
about the rules a little bit, but essentially they're giving out $10,000 in select zip codes, which is most of the affordable areas. It's something like 231 zip codes throughout Michigan.
Mm-hmm.
Places like, all over the place, any place that's affordable, has affordable housing in it, that program typically works. And there's a map, we can get you more information on that. If the house you're buying is not in one of those zip codes, then they still have down payment assistance available. It's just a little bit less, $7,500. Okay, and this money is not free money, but it is very useful to those who need it.
Mm-hmm.
It is, let's say you're buying a house for $150,000, and your down payment for this particular loan type is 3.5% of $150,000, and there's another several $1,000s in closing costs for property taxes, insurance, the closing fees, the loan origination fees, and that total amount that you have to bring or would have to bring out of pocket is, let's say, $12,500 to buy a house. The MISHDA program will give you $10,000 towards that total, so that you only need to bring $2,500. You're only required to bring 1% of the purchase price with that house, right? 1% of 150 is $1,500. So if you can come up with $1,500, the seller, we can negotiate with the seller to try to have them pay for $1,000 of that 2,500, and the MISHDA would cover everything else. So that's usually what we're trying to do when people are real low on the funds that they might need, because that's a realistic example of the total cost that you typically need. At that 150 mark is probably around $11,000 or $12,000. MISHDA will cover just about everything, so that you only need to bring the 1%. Again, it's not free money, so it's a second mortgage on the house, but it has zero interest and requires zero monthly payments on that $10,000.
Okay.
If you sell the house, though, it's a lien, it's a mortgage on the house. All liens on the house get paid off when you sell, so it
Yep.
just comes out of the proceeds. But like in our example earlier, where you bought a house for 100 and it's worth 200 in 5 to 10 years, if you have $125,000 coming your way, paying off that $10,000 you borrowed up front is not that big of a deal at that
True.
point in time.
Very true. And let me ask you a little bit about those down payment costs. So you were saying that they give up to 10. You said 10,000, right?
10,000. Yeah.
Yeah. So that goes towards, because a lot of people, as their closing costs, they group everything together. That means they group in their down payment for their loan and their actual closing costs. So those are two types of costs, though, right? Do you know what I'm saying? Can you kind of
Yes, I do.
further?
Absolutely. Yeah. Let me elaborate just a little bit.
Yeah.
What we're talking about most of the time is like, what's the cost, right? And what we mean by that is like, how much money do I need to buy this place, right? And also, how much money do I need per month to pay for the payment? That's called cash to close. It's called cash to close, right? And that cash to close number is just a total, right, to close on the house. And I can explain a little bit more, there's a little bit more detail that goes into that about how that actually works at closing. But the cash to close is a total amount that you need. That includes the portion of the purchase price that the loan does not cover. That's called your down payment, right? The loan you can borrow, we talked about borrowing 97%, right? I can borrow 97% of the purchase price. I got to bring the other 3% to buy the item. Now, above and beyond that, there are costs as well. Costs for property taxes. I have to pay property taxes in Michigan in advance as a homeowner. So when I go to sell my house, I've already paid property taxes for the next 12 months.
Right.
But if I'm selling my house and I'm not going to use all 12 months that I've paid, the buyer of my house has to reimburse me for the time frame that I've paid for, but that I'm not using. So that's tax prorations, right? There's also you'll have an escrow account attached to your mortgage, and the escrow account's job is to pay the taxes and the insurance when they come due in the future. And you've got to load up the escrow account with a couple of months worth of taxes and a couple of months worth of insurance, so that by the time you make your first mortgage payment, your second mortgage payment, your third, and so on and so forth, that you will have enough money in your escrow account to cover those bills when they come due in the future. So that's a little bit about property taxes and insurance. There's also costs for title or settlement charges. That's the lender's title insurance policy that you will get as the buyer. It's an insurance policy for the title of the home. And there's also generally a closing fee. And so that is a settlement fee. A closing fee is what the title company or the settlement agency charges to handle the actual transaction. They work as a neutral party. So they hold funds from the seller, they hold funds from the buyer, they disperse monies to pay off certain things or to pay out certain people, and to manage all that and prepare the closing documents as well, that like the deed that you're going to sign at closing to transfer the ownership of the property and other things like that. And they charge a fee for that. So that's part of the closing costs as well. Now you'll also have an appraisal fee. You may have a private home inspection that you're going to do. Most likely you will have that. That's also, considered a cost of buying a home. And your lender will have fees that they charge to actually fund and originate the mortgage for you. All those fees are customary that you'll pay as a part of your total closing costs. Closing costs can be paid for by the buyer, by the lender, by the seller, or by any interested party in the transaction can contribute to a portion of covering some of those costs, or the buyer can pay them all.
And that kind of leads me into the lender credit portion too.
Yeah.
Is that so? That helps. The lender credits help to pay the closing costs, and that's when you say that's what you mean when you say the lenders can help pay the closing costs.
Yep, lenders can help to pay closing costs as well through lender credit. So typically, let's say the average interest rate on a 30-year fixed today is 3.75, which is pretty close to where it's at actually at the moment. You might be able to, if you ask a lender for a lender credit, they could say, well, what we can do for you is a 4% interest rate, and in exchange for the 4%, we can give you $2,000 up front towards your closing costs. Or we also have an option at 4.5, and your monthly payment's going to be this much more at 4.5, but we'll give you $5,000 towards your closing costs to make it more affordable for you in terms of out-of-pocket costs. Now, the higher interest rate means that you're going to pay more interest over the life of the loan, that you're going to have a higher monthly payment on that loan. But oftentimes, if the interest rates market is going to stay relatively stable, and we have no way of knowing that now, we don't have a crystal ball, so we can't predict. But there's been a lot of times where we've done a 5% loan to give out $7,500 in costs, in credits to cover the cost. And then 6 months later or 4 months later, we went ahead and refinanced that loan down to whatever the market was at 3.5, and saved money on the monthly payment. And we're able to give some credit up front as well.
Awesome. Well, Andrew, let me ask. I don't see any other questions here. Huh. But look at the time.
Hey.
It was supposed to be 30 minutes, but Andrew, you gave a lot of information, and I know that you answered the questions I loved it. I appreciate you, and I'm sure all of the viewers do as well. And I would like to thank you for joining us today on our live question and answer session. And I look forward to doing more business with you. We work. You were great working together. You were great, and that's why you're here with me today. So, thank you so much. Is there anything that you would like to say to close out?
Just thank you so much for having me. I really appreciate the opportunity. It means so much to me. I'm somebody who really believes in helping people accomplish financial growth, and like I said, one of the easiest ways to do that is just by buying a house, believe it or not. And
Yeah.
you don't know what you might be able to do. Don't let fear control you. Look into your situation and try to figure out what your options are, and where you can move, right, and help to get your financial life on going. So I
Yeah.
just really appreciate the opportunity to be here and hang out with you and everybody. Thanks for the questions. I really appreciate it.
Thank you, Andrew. I appreciate you. So, everyone, that was Andrew Buck. I am very happy that you all joined us today. I am so happy because it means a lot to both of us. And I actually was going to do this video privately in our home buying selling tips group on Facebook. It is public, but I was going to do it privately. But as I was thinking about it, I realized I wanted to do something that would be able to give value to people. So a lot of the times you might see the slogan "Give value where value is needed." And because that's exactly what I'm all about as well as Andrew. So let me show you. Haha. This is our home buying and seller tips group on Facebook. This is where we were advertising for the question and answer session. I'm going to try to do, not even try, excuse me. I'm going to do it monthly to where we have an expert with us, whether it's a mortgage expert, a home stager, appraiser, inspector, like he was talking about the private property inspection. I want to be able to give you all value where it's needed. So please join our home buyer and seller tips group. Like I said, it is public. This is the profile picture for it if you're gonna go look for us. I don't have a way to post a comment on there. Yes, I do. Man, I love technology. Anywho, if you really enjoyed, it's not even if you enjoyed the information from Andrew, here's his information. Let me put it up a little bigger for you. His information, his cell phone, fax, and his website. Andrew, if you can tell me, let me bring you back on for a second because I want to. Here it is. Okay. His email. All right, Andrew, here's your email. I just wanted to put it back up there. Okay, thanks, Andrew. So here's his email up here. And I'm going to leave this up here for a second. So please take down his information. And it is also, let me see if I can. You guys, I wasn't prepared to put this in the comments. I didn't know I could put comments, but I know now. So I'll do that. And then I'll post it in the group as well. That's what I'll do. I'll post everything that I need to post inside of the group. Andrew, if you have anything that you want to post, you can put it inside of the group as well. Again, it is the home buyer and seller tips on Facebook. And if you are in need of any services, you please feel free to drop a question in the group or anything else. And if you are looking to buy, I have my home buyer's guide. I also provide a link in the group for the home buyer's guide. If you have anything, if you're interested in selling a property, I do have a real estate book out to help you sell your property. So please feel free to contact me for any of that information. And I will be glad to give it to anybody that you know who is looking to buy or sell in real estate, invest, whatever your need is. And here's my contact information. So feel free to contact me. I am on all platforms: Instagram, Facebook, LinkedIn, Twitter. I'm getting better on Twitter. I'm trying to get better on Twitter. I don't tweet as much as I should, but it's okay. So I am so happy, so happy that you were able to join us. And please look out for our next live question and answer session next month. It is February 8th, so it will be the first week in March. I don't have a date just yet, but like I said, if you have any professionals that you would like to see on our live question and answer session, please give me their information. Like, I love it. Give them to me. Let me give you value where it's needed. So like I said, thank you very much, and I would like to see you guys later. So, oh right, please save this because I was late. Don't you worry, I'm gonna try to save this. Technology, right? Okay, so love you guys. All right. See you. Bye.